Money is a very interesting topic. It all starts with the central bank. They create money by either printing physical dollars or just creating digital money. To put this money into the economy, the central bank would either lend this money directly to member banks or by buying securities from the open market. Typically, they buy safe securities like government bonds. But in times of emergency, like we saw in 2008 and 2020, the government might give a portion of this newly created money directly to their citizens as an economic stimulus. Regardless of the method of delivery, people end up with this new money, which will be deposited in a bank. This is where the economic system becomes very interesting. Let's say that you deposit $100 into your bank. When you go to the bank and deposit your money, they'll tell you that you can withdraw this money at any time. But this bank is only allowed to keep 10% of this money in their cash reserves. So they keep $10 out of your $100 and they invest or lend the other $90 to another person. But what if this person takes the $90 loan and deposits this money in the same bank? The bank also tells this person that they can withdraw their $90 at any time. The bank essentially created new money out of thin air because you still have access to your $100 and the other person also has access to their $90, even when the bank only has $100 in cash. This is what is called fractional reserve banking. This isn't much of an issue since most of our transactions are made electronically. Even if the bank doesn't have all the cash, if we pay for dinner with our card, a number just gets transferred from our account to another without affecting the bank's cash reserves. This becomes a problem when too many people begin withdrawing their money at the same time. Since the bank only has a portion of the money they owe to their clients, they won't be able to pay everyone. This is what is called a bank run. Everyone asking for their money back all at once, making the bank fail because it doesn't have enough money. This is one of the reasons why when you go to the bank, you see that little sign that says FDIC insured. The FDIC stands for Federal Deposit Insurance Corporation. In other words, the federal government protects your money that is in the bank in case the bank fails. The FDIC is extremely effective. If a bank is failing, the FDIC can quickly rescue it by transferring additional funds to the bank to help it survive and allow the bank to get people their money. But there's a limit. The FDIC can only protect $250,000 per person. This is great for the average bank member since most people have less than $250,000 in the bank. Things get a little more serious for large depositors. Let's say that you are a new startup and you raised $10 million from investors to operate your business for the next 5 years. You deposit this money in the bank, then the bank fails. Everyone is withdrawing their money and the bank runs out of cash. The FDIC shows up and gives everyone their money, but only up to $250,000. Out of the $10 million you had, you can only access $250,000. This puts you in a tough place because you had 5 years worth of operating expenses for your business, but now you only have enough money for a month and a half worth of expenses before you ran out. Now, this doesn't mean that you completely lost the money. You might still be able to recover your funds, but this will likely take years, since the funds will be recovered after the bank's bankruptcy court, once their assets are sold and liquidated to pay their debts. But by this point, it might be too late. As a company, you need the money now to keep the business going. As a result of a bank failure, you are forced to do a few things. 1. You can raise emergency money from investors. 2. You can lower your expenses by firing people. Or 3. Go bankrupt, since you don't have the money to pay for expenses. All of this have pretty tough consequences on a variety of people. If investors see that the business is struggling, they might sell their investments with your company, lowering your stock price. Your investors who still hold your stock lose money as the stock prices drop, and raising money becomes more difficult since you will have to give up much more equity to raise the money you need. This can affect your local economy. If you reduce expenses and start downsizing, unemployment in your community increases. This means that people in your local area must also lower their expenses or even default on their own debts. This is why bank failures on large scales can lead to an economic slowdown of the entire economy or even lead to a recession. This was the case in the 2008 financial crisis, where Lehman Brothers, the fourth largest investment bank in the US, went bankrupt. This disrupted the entire world economy. Although the main reason for the recession was bad mortgage investments, the closure of Lehman Brothers became the catalyst of the downturn of the entire world economy, since major international companies relied on their financial services. They asked the government for $700 billion to bail out the banks, but the US government refused to bail them out, and with no other option, Lehman Brothers failed. Over the coming year, the S&P 500 fell over 50% from their previous year's high. Money markets and real estate markets collapsed, and this is now known as the Great Recession. And recently, we had two of the biggest bank failures since the Great Recession: Silicon Valley Bank and Signature Bank. These banks failed due to the mechanics of fractional reserve banking, bank runs, and a few bad investments. As it turns out, Silicon Valley Bank used a major portion of their depositors' money to make some investments that would normally be considered safe investments. They invested $100 billion of their members' deposits into treasury bills. The investment itself was not necessarily bad. What created a problem was the size of the investment and the timing of the market. You see, a treasury bill or treasury bond is a form of debt that you as the investor give to the government, and they promise to pay you back with interest at a specific time. Now, as an investor, you can buy or sell bonds in the open market before the bond matures. For this reason, when interest rates go up, the value of your bond goes down, because other people can get new bonds with higher returns. And when interest rates go down, the value of your bond goes up because new bonds produce a lower return, making the previous bonds more valuable. Silicon Valley Bank bought $100 billion worth of treasury bills back in 2021 with an interest rate of 1.79%, and they were locked in for the next 3 to 4 years. What they didn't expect was that the Federal Reserve had massive interest rate hikes going up to 7% in 2022. This meant that the value of SVB's bond portfolio dropped. Normally, this isn't a problem, because they can just wait until the bonds mature and get their original money back plus interest. The problem happened when tech companies started withdrawing their savings, which put pressure on the bank's cash reserves. So they decided to sell their bond portfolio. But this meant a $1.5 billion loss. The bank also announced that they were looking to sell a third of the company to raise $2.25 billion to offset the losses and continue to handle withdrawals. But word got out that the bank might be in trouble, and by the end of the next day, the price of the stock was down 60%, making it much harder to raise the money they needed. This made members panic and rush to the bank to withdraw their money. Silicon Valley Bank was not able to raise money due to their low stock price and quickly ran out of cash before they could figure anything out. And it all happened within 2 days. Luckily, the federal government jumped in to save the day. They announced that all depositors will not only be covered by the FDIC insurance, but anyone with more than $250,000 will get all their money back, courtesy of the US government. Let me know in the comments what you think about fractional reserve banking. Do you think it's a good system, or do you think there's a more effective system out there? And make sure to check out this video on the book Tax-Free Wealth by Tom Wheelwright to learn how the rich avoid paying taxes.